without even realizing it. Most people develop attitudes that makes them fail consistently in trading. What I mean, fail consistently for several months and several years, and the whole summary of their experience with trading is just losing. Most of these attitudes you might be exhibiting, you do them without even knowing. It comes from either childhood trauma or because of what you see parodied on social media. From mere attitude, it turns into unbreakable habits that keeps you going round in circles. And this video, I'm going to be talking about some attitudes you exhibit even without knowing that is destroying your trading account, and how they affect your trading accounts, and also how you can finally stop them. So the first attitude is trading with money you cannot afford to lose. So there is something that happens when most traders start trading. They learn a strategy and learn some things about risk management and some things about psychology, and then they say to themselves, it's time for me to make money. They take it as a business, as something that they can now do, because trading, why not? You've spent months, you bought this mentorship or you bought that course, you've spent months learning how to trade, so why don't you now put money and trade? Of course, just like opening a business, starting a business, you have to put in money and expect returns, right? Now, the problem with this is that trading is just not like every other business. Your performance relies 100% on your psychology. So what it means is, just like other businesses, there will be down times where there are poor sales and poor returns, when you are still struggling to break even, whereby the money you invested in the cost of goods and services have not been fully recovered because you just started. Now, if it's a normal business, it's okay to go through it. You'll be like, okay, as long as I'm getting customers, one day I'll break even. But in trading is different because you cannot know the future. Everything is purely unpredictable, and you are working with your psychology here 100%. It will be harder for you to consistently follow your trading rules and do everything you have been taught in times of drawdown. Now you're not going to see the drawdown as something temporary. You're going to see the drawdown as horror, and you will fight it. And that fight is going to make you blow all that money. Now, for so many traders, they think the trigger is that I need to work on my psychology. No, you cannot work on your psychology without working on the triggers. The trigger is the main issue why you went into a mental tilt. You're trading with money you cannot afford to lose. You're trading with all your money. That is the problem. Now, no matter what you've learned and no matter how many years you've stayed in the markets, if you trade with all your money, you would mess things up, because losing is inevitable and losing streaks are inevitable. And when you have all your network in your trading accounts, you must, okay, it's a must. It's something that will happen, not me. You will lose all of that money. So what's the advice? You should trade with money you can afford to lose. If I would recommend 10% of your entire net worth or 20% of your entire net worth, this is what you should invest in the market at any stage of your trading career, because you're just human. Number two, using multiple time frame analysis. Now, there is this thing we all hear on YouTube, top to down analysis, top to down analysis. Now, it might sound like it gives you a better edge in the market, but it doesn't. Trust me. What the market rewards is routine and not the type of strategy. Because if it's about the type of strategy, then every other successful trader you know out there will all be trading one style, because that's the only style that can make them profitable. But trust me, many traders trade differently. Many traders that trade differently are still successful, because the market does not reward the strategy you use, it rewards routine. And the best thing to do is, how can you attain routine? You can be able to hit that routine consistently when you're doing something easy. When it's easy, then it's repeatable. When it's easy, then you make less mistakes. When it's easy, then you can even do it when drunk. You can do it when you're at vacation. You can do it when you're at the club. And until you get to this point, you won't be profitable. So looking at multiple time frame analysis exposes you to multiple mistakes, because not reading a time frame correctly can cause an unnecessary loss, or having one time frame counter what other time frames are telling you can lead to confusion in your head. So the best thing to do is to either stick with one time frame or three time frame max. And if you're sticking to three time frames, separate the rows. Example, just like me, the 4 hour time frame is for my structure and direction. The 1 hour time frame is where I get the level to trade from. The 5 minutes time frame is where I get confirmation from. You should try to assign specific roles to these time frames, that it will not bring confusion and stress in your trading. But really, trading without a checklist. Now, if your trading is very chaotic, intuition based, and not systematic, you will find it really, really difficult to put it in actionable steps. A checklist is that little list of steps you have to follow before you place a trade. Now, for traders that trade all the that look at all the time frame and do things based on intuition and gut feeling, they will not be able to have their strategy put in a checklist. And this is the number one red flag why you shouldn't trade strategies like that. The strategy has to be easy and repeatable, and a checklist will protect you from breaking your rules. If all you can say is, I need to make sure all these boxes are ticked before I place a trade, then that particular checklist will save you from taking wrong trades. This is a mind hack that helped me so much during my time. If you are trying to get profitable, I recommend you adapt this process. It will help you become really, really disciplined. The fourth attitude that so many traders portray without even knowing is ruining their trading account. Is trying to trade liquidity without the concept of market structure. Now, there are folks out there on YouTube that always tell you all you need is liquidity. All you need is liquidity. The truth is that what is liquidity? Literally highs and lows in the market. Every single high and low are all liquidity points. So how do you know what liquidity is going to be swept at a particular given period? You don't want to put yourself into scenarios where you would have to guess or judge or compare, because when you do that, you give the power to your emotions to take over. And trust me, when you're in a losing streak, you would lose trust in yourself and judgment, and it could really, really send you crashing down. So in as much as there are liquidities everywhere, the best thing to understand is market structure, so that you can know the right liquidities price will most likely hit. Example, if the market is in a bullish trend, then it's wise to trade towards buy side liquidities. And if the market is in a downtrend, then it's smart to trade towards sell side liquidities. With this, you can tell what areas you should be looking to trade into instead of drawing highs and lows everywhere and guessing where price will go, or going to the lower time frame to look at order flow or price delivery to know. All of this guesswork is the true nature of trading that says you can never know the future. You can never know what price is going to do. And if you think you can read the market and read price delivery and know where it's going, then you are wrong. It's a matter of time. You really, really get slapped in the face by the markets. The fifth wrong attitude that you could be doing, and also many traders do, is using consistent lot sizes. Consistent lot sizes doesn't mean you're risking consistently. Consistent lot sizes mean you're just doing it the easy way. Trust me, most of those trades, when they hit stop loss, you will lose more than your average win. And that is completely wrong. You're not supposed to use the same lot size every time, because for certain pairs, certain lot size mean different value of dollars. So you should learn to risk a particular amount of your account consistently. Now, if you're this kind of person that wants to trade and withdraw all your profits, and let's say you start off with the $1,000 account, your goal is to always trade and withdraw the profits. Now, if you go in drawdown, you shouldn't change the risk you are assigning to the account. Let's say you're risking 2%. For a $1,000 account, that's $20 per trade. Now, when you start going to drawdown, it's important that you don't reduce that risk. Why? Now, the reason is because when you reduce the risk, it makes it even harder to come out of drawdown. Now, people that are meant to reduce risk are people that are trying to compound, because as the account grows, they are also going to increase risk. But if you're going to only withdraw the profit and always keep the account at 1,000, and when it crosses 1,000, you withdraw it, then it's important you risk a significant amount, which is 2% of the initial deposit. Even if the account has gone 50% in drawdown, you have to stick to that, because that's the only way you have a chance of ever bringing it back up if the market conditions start to suit you. So risking a particular amount of money in your account is key. And to do that, you have to use the formula amount to risk divided by number of stop loss pips of that trade divided by pip value of the pair you're trading. So what is pip value? Now, for some pairs, a pip movement costs $10, just like pairs that end with USD. While for some pairs like JPY, a pip movement costs 7.12. For pairs that end with Canadian dollars, a pip movement costs 7.5. Now that's a constant. If you're trading any of these pairs that end with any of these currencies like USD or JPY or CAD, while you're following the initial formula, amount to risk divided by number of stop loss pips used in the trade, that last division has to be with the pip value, and it's a constant. The answer you get is going to be the lot size you have to use. Now, if you get it in decimal, you have to round it off to the nearest 2 decimal place, and that's the lot size you use. Now, if you use this lot size and you lose the trade, you'll be losing exactly or close to exactly the amount of money you actually trying to risk. Now, this is a smarter way to manage your risk and not consistent lot size. The sixth attitude that tear traders accounts down is not journaling and reviewing. So when you come on your chart and trade every day, just come, you lose or you win, you come the next day, you trade. I bet you are gambling. Why are you gambling? Because the difference between businesses and gambling is that in business, you have to always review what you have been doing, always see how far your employees are working. You want to see how far your product is how much your product is making. You want to see the mistakes. You want to see what your other competitors are doing. You want to see how the economy is affecting your income. You want to look at the paperwork. Now, only gamblers just go put their money and never plan. So, trading, there is a thin line between trading and gambling. So, if you want to be a gambler, then come to the market every day and place trades. But if you want to be a real trader, then you need to have quiet time where you journal your trade and review your performance for the day, for the week, and for the entire month. So, at the end of the month, you're reviewing the entire month. At the end of the week, you're reviewing the entire week. At the end of the day, you're reviewing what you did that day. With this, you can try as much as possible to make sure you eliminate certain habits that show up in your trading that make you deviate from the checklist you trade with. Now, no matter how much you lose, you shouldn't be trying to tweak the strategy out of the checklist that you have created. And for you to be using a checklist, it should be that you have tested it and seen that it has a proven edge. So, this journaling and review is to make sure you are not deviating from the checklist in real life. Is not to make sure you don't lose, because losing itself is inevitable. Number seven, not having a backtesting routine. So some people take backtesting as something they do every weekend. Some do not take it seriously. Some think if they get funded, then they're going to stop. Trust me, as a trader, backtesting should be a routine of 1 hour or 2 hours daily. Why? Now, you should be able to gather as much data as possible about your strategy. Why? So that you can see the worst case scenarios of it and the best case scenarios of it. Now, this would keep your psychology in check and make you normally numb to wins and losses. Trust me, if you're not numb to wins and losses, you would never have a stable psychology. What causes your psychology to shake in real trading is a stack of wins or a stack of loss. Multiple wins in a row, people start misbehaving, adding more lot sizes, adding more capital, and increasing their risk, doing all sorts of crap. Too many losses make people to change their strategy, tweak their strategy, jump from mentorship to mentorships. So how can you ever eliminate these triggers? The triggers are P&L, right? Profit and loss. So to eliminate them, you have to be numb to profit and loss. The feeling of the euphoria of winning should not affect you, and the pain from losing should not affect you. And what happens if you can get yourself to this level? You are a good trader. And how do you get there? By consistent backtesting every single day to build that stoicism. And that's why I crafted the mentorship program, because doing all these things on your own might be difficult. Example, how do you know the checklist you're trading has an edge? How do you know? Well, you have to test it for a really, really long time, probably 5 years. And is so much more work than learning from somebody that already has a proven documented edge. So if you have a strategy you don't trust if it has an edge or not, so it's best you join the mentorship if you can afford it. Now you'll be taught the strategy that got me funded, and also be taught how to be consistent and be disciplined trading that strategy. Be given different tasks that will help your psychology. Example, like backtesting a particular price action under my supervision, and some other practices that will make you become a consistently profitable trader. Now, if you want to join the mentorship, that this video, go to the description. You'll see the first link. It's going to lead you to my Telegram. All you have to do is message me with a mentorship, and I'm going to tell you the pricing and everything you need to have in place before you are eligible to join the mentorship. What do you stand to gain after the mentorship? Consistency in your trading, being able to be funded, and able to pass multiple Profem accounts using my bulk Profem passing strategy. So I'll see you in the Telegram. And if you enjoyed this video, you're going to enjoy even more videos I have made concerning trading psychology. You can check it out. Peace.